Let's talk about a quiet revolution that's happening right now in Sri Lanka's insurance industry. It's called SLFRS 17, and trust me, it's not just some boring new rule. It's a massive shift that is going to completely change how we see the financial health of some of the country's biggest companies. If you dig deep into the latest annual reports from giants like Lankan, you can actually see them getting ready for this. And we're not talking about small tweaks here. This is a fundamental change in philosophy, a move away from a system that allowed for, let's just say, some creative accounting, to one that's based on cold, hard reality. Think about it like this. What if a company could report its profits on the very same day a customer signs a contract? Sounds a little strange, right? Well, for decades, the rules basically allowed for that. It created a pretty warped picture of their financial health. SLFRS 17 is the fix, and it's designed to bring a much-needed dose of reality to their balance sheets. So to really get what's going on, you can't think of SFRS 17 as just another software update. It's more like the entire industry is learning a completely new financial language. And what's the goal? To finally have one universal standard so that insurance accounting is consistent and transparent, whether you're looking at a company in Colombo, London, or Tokyo. And this change hasn't just popped up out of nowhere. The rest of the world started getting on board with this new standard back in 2023. Here in Sri Lanka, 2025 is crunch time. It's the year of intense preparation, all building up to the mandatory switch on January 1st, 2026. These companies are right in the middle of it as we speak. So what is actually changing? Let's break it down. We're going to put the old standard, SLFRS 4, right next to the new one to really see the core differences. This is where the story gets good. Okay, so take a look at this. On the left, under the old rules, figuring out liabilities, what an insurer actually owes its policyholders, was kind of open to interpretation. But on the right, with SLFRS 17, it's black and white. Liabilities have to be measured at their current value. And the biggest change of all, profit is no longer booked on day one. It has to be earned over the life of the policy. That is a massive, massive shift. To really get to the heart of this, there are two new terms you absolutely need to know. Now, they might sound super technical, but I promise the ideas behind them are actually pretty straightforward. First up, we've got fulfillment cash flows, or FCF. Honestly, the easiest way to think about this is as the insurer's rainy day fund. It's their most realistic, up-to-the-minute calculation of all the money they expect to pay out in future claims. It's like they're opening up their books and showing us the real obligations, plain and simple. Now for the second concept, and this is where it gets really cool, the contractual service margin, or CSM. Just think of it like a profit jar. When you buy a policy, all the future profit the insurer expects to make from you goes into this jar. But here's the catch, and it's a big one. They can't touch it all at once. They can only take a little bit out each year as they actually provide you with insurance coverage. And that is the single most important change right there. That jar of future profits means the old game of booking a huge profit the second a policy is signed is over. Done. Profit now has to be earned over time, which gives us a much smoother and, frankly, a much more honest picture of how a company is doing. Okay, so that's the theory. But how are the big players in Sri Lanka actually dealing with this? Let's take a look at what market leaders like Lankan and H&B Assurance are saying in their own reports. Listen to this. Lankan themselves are calling it the most significant transformation in insurance financial reporting in decades. When a market leader uses language that strong, you know this is a seismic event. They're updating everything, their systems, their processes, you name it, to get ready for this. And then you've got H&B Assurance, and they're highlighting the benefits. They jumped on this early, focusing on how it strengthens accuracy and transparency. For them, this isn't just about ticking a box for compliance. It's about building real confidence with regulators, investors, and customers. So, why should all this matter to you? Well, whether you're an investor, a policyholder, or just curious about the economy, this is a big deal. Because this new standard promises a level of clarity and honesty we just haven't had before. So, what's this going to look like on paper? Well, first, balance sheets are going to change. Liabilities will probably look bigger, which sounds bad, but it's actually a good thing. It's a more honest number that can impact a company's net asset value. Next, income statements will show smoother, more realistic profit streams. And finally, cash flow statements will give us a much better look at how much actual cash an insurer has on hand to pay claims. So here's the new reality. The huge gains are comparability and visibility. For the first time ever, we'll be able to truly compare apples to apples between different insurance companies. The pain, of course, is the massive cost and complexity to get there. It requires enormous investments in new technology and some very smart people.
Which really brings us to the final thought here. This isn't just a simple accounting change. By forcing companies to show profit only as it's truly earned, SLFRS 17 is fundamentally changing the definition of performance. So it leaves us with a big question. How will this new, more transparent financial language reshape our entire understanding of success and stability in Sri Lanka's insurance sector?